maybe the first question that I'm always asking our guests, can you do a little bit of the intro highlighting what experience and what you have been doing in this fantastic industry?
Well, I would say that it's not often that I hear that lending itself is a fantastic industry, but with the things that we do at Neofin, we try to prove that it actually can be innovative and even, in a way, exciting. So we are Neofin. We are a lending infrastructure platform that enables the launch of any product that involves financing as an aspect, and that can involve financing of a customer, a user, a consumer, or a business that would help them achieve certain financial goals. So we provide all the technology components. I would call them all the bricks that are required to build the loan product and make sure that it operates on the market.
People are underestimating the power of the financial instruments and lending included, because the modern capitalism is built on the lending and ability to generate the financing for the project, because you cannot go solely on the liquidity and available capital for doing the great things. And maybe a little bit coming back to your experience, you're CEO of the Neofin, like what is your personal maybe accountability or the part that you feel the most strong with? Is it financial part? Is it dealing with the clients like that? So a little bit more meaty about yourself.
I have historically been in business development. I've been in the international business development for, I would say, 12 years now. And my specialization has always been helping the businesses with Ukrainian roots, but global distribution, achieve the markets they need to flourish on the global arena. And Neofin has been just like that. So Neofin has initiated and originated in Ukraine, which is like, I would say, a heart of fintech innovations in many aspects. And it was designed as a local product for the local players in Ukraine. And at some point, Neofin gained probably the leadership status, working with the major financial institutions. And it was built by ex-CTO of a number of Ukrainian largest, lending techs and fintechs, which is my co-founder, Alex Kshutashvili. And at some point in 2022, due to a number of factors, the need has become to bring it to the international market. And we realized that there has to be a lot of pivoting in the product philosophy, in the product strategy, in the way it is structured, it is built, what is the components. From the goal, initially we had a goal of entering the US market and launching in the US market. We launched in the US in August 2023, but then we realized that what we are building has to be a geography agnostic platform, because the pains that the lenders and the financial institutions were coming to us with from Eastern Europe, from Southern Europe, from Western Europe, from Middle East, from the North America, those pains were all alike. They had differences and nuances and regulatory aspects, but they were all alike. They were all around the scalability potential and ability to launch the products in line with how the financial market is evolving and what the user of the financial market is expecting.
Okay, that totally makes sense. And I know the story for the local business grabbing specific market share and then understanding that it's way more than just a local story. So congrats for hitting the global market. And it brings us to the basic. You mentioned that the needs are the same. And for me, it's like letters in wording, because you need to understand the basic mechanism to put the words together. So let's go through the financial products in lending, and then we can go and dive deep and compare them by nature and the needs from the technology. So maybe what is your feeling nowadays? What are the main financial models that are existing in lending?
If we speak about the product models, I would divide this into two groups. One is evergreen classics, and one is a growing segment. So the evergreen classics group would be term loans. This is classics for consumer and for business. We work specifically with a small and medium business segment. That would be term loans, and that would be credit cards, consumer and business credit cards. This is the classic that has been there for a lot of time and is going to persist no matter how the predictions say that classic lending is dead. We do not see this coming, at least in the nearest, I would say, 50 years. And then there is the growing segment. The growing segments are buy now, pay later, and the products that we see that are kind of on the edge of classical static lending products and dynamic lending products, such as credit lines, specifically revolving credit lines, both in the consumer and business segment.
Once again, I'm really happy that we're tackling the topic of buy now, pay later and revolving credit. Is it the segment is growing due to the demand of the market or any other facts or triggers impacting the usage, how the customers are using? Because definitely credit cards are there. And we've seen the numbers for this year in the United States, the number of the credit cards still growing. But on the other hand, the statistic is saying that new generations, they tend to use the financial instruments a little bit different way. And in this case, like, what is your opinion? Those segments existing and kind of name growing, what are the reasons for that?
I would say that there's a chicken and there's an egg. And here, the chicken and an egg are, on one hand, the consumers of the financial products and their expectations and needs. And on the other hand, the lenders and the products that are easy or difficult for them to launch, run, and operate due to different factors. And I would say that the fact that these two products are growing is related to, I would say, synergy between the two. Because if we look at the consumer, I would probably touch the small business segment because we've been working with this segment specifically actively during this year with the small business, classical small business, with the revenue-based financing, with the merchant financing. So what does the small business want? The small business wants working capital, wants access to working capital. During the years, they have been a classically underrepresented segment in the financial industry because when they go to a traditional bank, and we're talking now holistically, we're not talking about a special geography. Holistically, they are underrepresented. Yeah, a bit of like in some markets, they are a bit more presented, in some less, but still the trend is the same. When they go to a classic bank, they're requested to provide a number of documents that, let's say, a corner coffee shop in the neighborhood doesn't even know about such documents. They don't know if these documents exist. This way, they are deprived of the working capital. And if we look at different markets, I've been checking the stats from the UK. 65% of small businesses close in the first 5 years due to this simple reason of not having access to working capital, right? So they need a working capital. And since they have been always deprived of the classic, ways to access this capital, they needed easier and more flexible solutions. So this is the consumer side. And then here's the lender side, right? So on the lender side, opening the business credit card means a lot of potential hurdles because they need a partnership, firstly, with they need a partnership with a BIN sponsor, with a license partner. They need a lot of compliance and procedures in terms of managing the limits and dynamic control of those limits and so on. So it is fairly difficult to launch a classic business credit card product. At the same time, here's where the small business credit line comes into play, where on one hand, it is much more dynamic. It is offering, let's say, a total amount, but it is not provided as a lump sum. The business can withdraw the amount that is needed at this current moment and dynamically repaid. We are dealing with this dynamic lending behavior that is very similar to the credit card because it's withdraw, repay, withdraw again, repay, withdraw more, and grow more, right? But it is not a credit card and it doesn't require all the hurdles that are needed for the small business to get a credit card. So it is much more flexible. And what is interesting here is a flexible interest rate, because on one hand, we have term loans, which are very clear and very standardized, right? You as a business get $100,000. Here's your interest rate, and you are just paying off the repayments. Here, you pay the interest on what you withdraw. So if you didn't withdraw all the $100,000, you actually are not paying interest for the whole amount, which is a direct value for the actual borrower. And I can say that from the practical perspective. I've been talking a lot to the small businesses. And just an example from the recent times, I've been talking to my friend. My friend is running a construction company here in Canada. 5 people. They're running certain projects. They're about to onboard like a bigger project than they used to before. And he says that, well, the friend of mine, he says, well, there are a certain amount of risks that, we still have 150K of borrowing potential through our credit line. So we can build without anxiety. That's why we're actually entering this larger product. And I understand that as a founder, as a founder, it is so important to realize that there is this point of the backup that you will not necessarily withdraw all those $150,000, but you're more likely to take riskier business decisions and take over bigger projects, which is actually better for the contractor, better for the customer, and better for economy because we get more money flowing. And this is how the revolving credit line works. It's actually becoming a driver right now for the small businesses in multiple geographies. We have, this year, we have launched two credit line products with different segments, one with the business, one with the consumer. In the Eastern Europe, we're getting a lot of requests from the North America too. And I would say that in the North America, the primary reason is, I would say, the convenience for the lender, because it's much easier from the regulatory perspective and operational perspective to launch a credit line than the actual credit card for the lender.
That totally makes sense. And maybe in this case, like the analogy that I'm thinking in my head is the comparison between cinemas and Netflix, because it both give you the content, like you really would like to watch a movie, but the difference is that the revolving credit reminds me an ability just to browse through and see if I have an appetite to watch the movie right now, rather than plan in advance, buy the ticket, be in a specific place in a specific time. So the motto for the digital products right now becomes more personalized approach up to the needs, but not cookie cutters for everyone with the standard terms. It feels safe, like for the lending business, but it actually limiting the digital product and availability for those lending products for the end customers. And that takes us into the comparison maybe with the buy now pay later, because okay, I got it. Revolving credit, we assess somehow the business or maybe even the personal loan, and then we are providing this ability to utilize those funds for any financial activities. But what about the buy now pay later? Because I assume a lot of people don't have really good definition what it is and how it works, and having those atoms or letters to compare. Okay, it's A, it's a B. How are we going to construct the words with that?
So buy now, pay later is a different animal. You are completely right. Buy now, pay later is a product that allows to pay in parts for a certain purchase. This is a highly standardized product that is usually operated under pay in 4 or pay in 6, right? Like pay in part for certain products. One, the buy now, pay later product is specifically related to a certain purchase. So it's not like a certain amount of working capital for you to grow your business. It is related to your need to purchase this. For example, here in agriculture, you need to purchase a tractor. So your need to purchase this tractor at this very moment and your inability or unwillingness to pay for it right now. Right. And your ability, having a certain financial credibility, having a certain financial reputation and profile to pay for it in parts, understanding that you're accepting a slightly higher total price after you pay all the parts and all the repayments. Buy now, pay later has been booming and growing, I would say, like since 2 years ago in the consumer space. And there are certain nuances because there is this younger generation that is less willing to get a credit card, and they feel more comfortable with buy now, pay later because usually the buy now, pay later doesn't foresee those sophisticated credit checks, profile checks with the detailed income verification. We deal with those underwriting strategies when we set it up in the settings, so we understand from inside how much of those checks are required for, let's say, classic credit products. In buy now, pay later, it's the process is usually faster and more simple. Still, the buy now, pay later still remains almost completely invisible for the financial system and for the credit accounting. So I would say the credit bureaus still do not see your buy now, pay laters as your usage experience with a credit product. So for example, the buy now, you might have, let's say, 8 or 10 open buy now, pay laters. You will have an amazing credit rating. You will have like 700 plus credit score, but you will have 7 or 8 buy now, pay laters. Or for example, you can have a lower credit score and you will pay off your buy now, pay laters on time, but this will not impact your credit rating just because it is still very I would say it is still very unresearched. But I don't want to sound like I'm, promoting one loan product and being against the other. Definitely not, because we actually have examples in our practice where different types of buy now, pay later are doing good to the economy and help implement the fintech innovations in the market with low digital money and card penetration.
Okay, that explains a lot. And another element that I've overviewed in buy now pay later, usually the great spot or sweet spot for buy now pay later is placed in the triangle between merchants, consumers, and the platform which are providing. And it's so-called open loop merchant acquiring. When you specifically can check out with the buy now pay later, does it make sense only for this model, or there is a difference? Because if I work with the credit card, usually the checkout is happening on the acquiring side. Like we have the company which is taking the cards, and even for acquiring, the credit card checkout costs more. So basically, for this processing, the acquirer will pay more. And I see that in the cases when the open loop integration is done with the buy now pay later, technically the acquiring costs less because we kind of negotiating as a platform between consumer merchants, say, okay, that's an order. You don't need to worry about collecting the payments and even credit card processing. It in the behind the scenes, under the hood, it will be split into, I don't know, pay and whatever. And the company, which is providing buy now pay later, taking all the risk and heavy lifting in terms of payment collection, debt collection, even defaults with those debts. Does it make sense, more usability for the customers, or what is your overview and feeling about those differences?
I would say that for the customer, if we speak, because you have touched a very important topic, this is a topic of B2B2C nature of buy now pay later loan products. So if we speak about C, right, the consumer, the last chain, the last line of the chain, this does not make a lot of difference because for you as a consumer, anyway, you just use it as a checkout. You do not care what happens on acquiring. What are the commission rates of Visa and MasterCard networks? What is the relationship between the merchant and their financial institution? You barely notice if the POS terminal is powered by this or that bank, right? So for you as a consumer, it doesn't make much difference. Then when we speak about the merchant and the financial institution, now it gets more interesting because what is interesting for the merchant? For the merchant, it is interested, one, to get more customers. Sometimes they have customers, they want to buy this beautiful plasma TV for $5,000 for Christmas, and they understand that then they will leave everyone in the family without gifts. But they want this plasma, right? So, and they don't want to lose this customer. They know it's their permanent buyer. They want to get a customer on one hand. On the other hand, the merchant always wants to minimize the operational costs and the commissions that they pay, right, to the networks. And what does financial institution want? Financial institutions always want lead generation, especially if we speak about the classical financial institutions such as banks or in the North America credit unions. Lead generation to younger audience is always more complex, always more complicated. And through the buy now pay later products, they're getting basically their lead generation because anyone who wants to pay in part needs to enroll in their program, and they will become a user of a financial product from this financial ecosystem. So potentially, here's the contact details to whom we can sell potentially maybe a card, maybe a checking account, maybe some other financial product, right? So everyone has their own priorities. And here we come to the topic of lending as an ecosystem product. We're building right now, actually about to launch an interesting use case in Europe. I will not name the network for now. I think we will all know it in January, February. But here's an ecosystem where in the ecosystem, there is a major retailer network, and there is a bank, there is a financial institution that is also a part of the ecosystem. Thus, through implementing the buy now, pay later and a digital wallet, they are basically building a win-win strategy where the merchants get more customers and more profit, and financial institution gets lead generation and potentially profit. So I totally believe in the ecosystem-powered loan products, even not only in the buy now pay later products, but I just believe that when there's more collaboration between the different players of the ecosystem and more understanding of the priorities of each player of the ecosystem, this is where the actual consumer wins, because this collaboration brings better offers for the consumer.
I really like this approach. I'm talking a lot about game theories, and one of the formula in game theories is like a non-zero sum games where you put in one, and then I don't know, your partner in game put one of something, and then in the sum you are not getting two, you're getting three. So it's really good example and takeaway that if we're talking about the financial products and lending, usually it's non-zero sum game, because in this case, the institution who are implementing more complex and more ecosystem-driven products, they generating additional funnels for acquiring the customers and potentially growing their customer base, growing their average check, and et cetera, et cetera. So that's true, and that helps a lot. And you highlighted another hot topic from my side, is the technology required for do so. And in your understanding, like are those current financial institutions, let's name like big banks, like starting with the tier 3 to tier 1, are they really ready for buy now pay later? Because there are a lot of discussions that even Klarna, they didn't invent something out of the air. Everything was there, but somehow big banks, they lost this segment for buy now pay later and those products as revolving credit. Is it happening due to the tech, or the non or blind spot for this financial model? What is your thought here?
If we speak about the banks, right, the tier 1 banks, while Neofin is not having those tier 1 banks as a target audience, we work more with fintechs and non-bank lenders that collaborate with banks as sponsors, but we're not liaising with us directly. We have been involved a lot in the banking ecosystem. We are the alumni of BMO, Women in Fintech program. BMO is Bank of Montreal, one of the top North American banks, $1.4 trillion right now of assets. So that's a large bank. And when we were involved in that, we had, I worked with a number of mentors from within the banking industry. And classically, the banks are not a dynamic structure. So even if the bank is acquiring a new technology solution, what is the classical sales cycle for a bank to actually partner with a new technology solution? For a tier 1 bank, which is I would say over $1 trillion bank, right? That would be 24 to 36 months, optimistically.
That's crazy.
24 to 36 months of the sales cycle. Same happens to the nature of making decisions. And while there's a lot of frustration around that, but there's also a reason. There's also a reason why it is so, because with this scale, being, I would say, TBTF, too big to fail bank, has its price, right? It requires a lot of compliance, a lot of processes. And as a result, the banks are slower. So they're classically strong in the classic lending solutions and classic lending, terms, commercial lending, term loans, business lending, a bit less of the small business side. But speaking about the products on the consumer lending side, banks are very cautious working with the consumer credit and consumer lending in general. Banks, if we speak about the bigger banks, for them, larger priority would be getting more deposits, getting more checking accounts, and not dealing with that strange and unknown and very hardly traceable animal. So that's why I would say it is not their specialization at the moment. But at the same time, there are banks that are willing to innovate. They're challenging banks, they're neobanks, right? They're willing to innovate and they're getting into the segment. And if we look, for example, in the Canadian market, right, the innovative banking product, very new, very fast growing and strong, well, simple, right? That has the first solution that has made investments actually easily done, trackable, controllable, and enabled to have all your, daily banking products within the same platform where all your investments accounts are. Yes, it is not close to the large, gigantic Canadian banks like Bank of Montreal or Toronto Dominion, but they're already $100 billion of value, right? And they're growing. Why? Because the consumer is craving for that innovation and they would take it from wherever it's coming from. So I would say that classical banks are not the typical audience for the types of products that we at Neofin are launching. And that is the reason why we are always looking more into, one, the fintechs, the digital lenders or non-bank lenders, and large merchant structures and large merchant networks that want to accelerate their business and somehow monetize the major user bases that they have. Because every, let's say, big merchant, every retailer has a tremendous user base. But for them, it exists as maybe mostly the contact details and maybe their purchase and history and maybe some bonuses, some reward offers or discounts they have offered them for loyalty. But it does not exist as an actual business asset. And launching financial programs for this user base makes the base from just, several lines or like 100,000 lines of contact details. It turns it into the business asset. And this is the direction where we at Neofin look at.
That once again reminds me the case with the Starbucks, because in combined assets for the loyalty cards, Starbucks has a better net assets than a lot of United States banks. So it takes me to the embedded financing. So basically, you're saying that the product is more oriented as embedded financing to the non-fintechs who have a specific user base, which using the services or buying the product, and by embedding finance, those companies can benefit and drive more growth and revenues.
Yeah, totally. I would say that this is something that our brand new product is all about, because we are right now at Neofin, we are launching a digital wallet product. The digital wallet product will now enable not only the lenders, but actually the large merchants to have their own full-fledged wallet where the users can load the money, can transfer the money between each other, can make the payments, and can have the built-in financing functionality when they want to purchase that nice PlayStation, or they want to purchase that nice bag for Christmas, right? But they're not comfortable paying with it. But this is already a pre-scored user with history, with reputation, that can actually be instantly scored and assessed, and there will be the built-in financing functionality. And this is something that we absolutely see as our motto for 2026. And this is basically the type of ecosystem product that we're going live with, hopefully this January.
In this case, slicing the verticals and providing like embedded finance, it seems to be the motto for the last 5 years in all the verticals in the fintechs, because we see the embedded finance with the banking as a service. We see a lot of services evolved from the KYC and compliance process. And usually you are not building yourself as it used to be, especially if you take a look at the tier 1, tier 2 banks. So it seems that lending products are evolving into the self-standing platforms, which can be utilized for growing the customer base and even utilizing those lendings in non-financial products. But the last question for today is, I'm always using this trick on the latest episode. We discussed quite a lot, and I assume that there is something that we didn't go through or you would like to highlight to us. So the question is, what I didn't ask you today that you would like to share with our audience?
You know what? That's a very interesting question. I think what we didn't touch is the actual hardcore tech behind any lending product, because the technology makes it look simple. Like for me, as a user, I just, when I want to pay for something in part, I just make a purchase on Amazon and I just choose pay in part, for example, right? But everything that happens on the background is a hardcore tech. And all of that is basically every component of the lending ecosystem that we as Neofin provide as a platform solution, right? So the loan origination piece, where every user details needs to be thoroughly checked. My device needs to be checked for the reputation of the device, if there's any fingerprint and any malicious operations from my device. My contact details need to be verified, because the business needs to confirm I am actual Svitlanka Sergiichuk and I'm not like John Smith, Then I need to be verified. Then my risk profile needs to be assessed. My credit worthiness needs to be assessed. Then the money needs to actually, so I would pay my part, but the full money needs to actually reach the merchant, right? Then the merchant needs to get this money. Then there has to be some agreement between me and the financial institution to charge those repayments. And all of that is just covered behind this little simple button of like pay in parts. But all those technology components are actually the hardcore lending tech and all the magic that happens on the back office. And this cannot be underestimated, because the tech behind lending very frequently defines how effective this product is going to be, how useful it's going to be to the user, and as a consequence, what kind of revenue it's going to generate.
As DashDevs, as a software engineering and product development company, we understand that usually the idea costs minus 1 million. but the execution and ability to deliver to the product, to the market, something which is can be in competition with the existing products or drive the competition to existing products is really essential. And people are underestimating the efforts because like this button is working and it might need thousands of hours of thinking, designing, testing, debugging, deploying, and then making sure that it will drive the financial innovation.